Greg, welcome. Greg, how are you seeing growing convergence between public and private credit impacting on deal flows and pricing?
Georgie, if we think about the private credit market, 10, 15 years ago, it was a tiny portion of the overall credit markets. But as the asset class has grown and become commoditized, it's become a real part of the credit universe. So overall, there's 5 trillion of high yield debt in US and Europe. It's split about evenly now between leveraged loans, high yield bonds, and private credit. And so, as private credit has become more relevant, we've seen it compete directly heads on with high yield bonds, but even more relevantly with leveraged loan applications. And as that has occurred, we're seeing both asset classes track each other very closely in pricing and in default rates.
What's the rise of direct lending doing to capital structures, and what are the risks associated with that?
Yeah, so as we look at this mature asset class now, we've seen lenders historically loosen up their lending standards. And so if you compare the direct lending portfolios to broadly syndicated loans, the quality of the issuance is a lot lower, right? And whether you look at leverage statistics, whether you look at debt service coverage, any way you cut it, they lend to weaker credits. The weaker credits will bring higher default rates, right? And so if you look at the average loan in the direct lending portfolio, it pays about 150 bips of extra spread versus a single B rated broadly syndicated loan. The single B broadly syndicated loans default at 10, 12% cumulatively through the cycle. Triple C loans default at 25% through the cycle. So you're going to have a portfolio default rate for direct lenders of somewhere around 15%. The direct lenders are not all equipped to deal with these problem loans. So we're going to see a wave of restructurings. We're going to see a wave of unnatural holders of risk. And eventually we're going to see selling.
With credit markets evolving fast, how are you balancing risk and return across regions, across strategies?
Georgie, we're seeing stress in both US and Europe right now. US, a lot of it is coming with a political change. Europe is you had a problem with demographics. You had a slow growing economy for 2, 3 years now. So there's a lot of global stress in the system, to your point. The way we're looking at this, we think the opportunity is going to get deeper. We think the pricing is going to really come to us. And we're seeing a lot of non-economic sellers, whether it's commercial banks, whether it's CLO vehicles, who are all going to sell once they see hard events and handover of keys from sponsors to them. So, we're starting to buy, but we think the pricing is going to get more attractive this year.
Greg, thank you so much for your time.
Thank you, Georgie.